Hello and assalamu alaikum everyone. Previously we've talked about published accounts, we've talked about income statement, we've talked about statement of financial position, we've talked about ratio analysis, liquidity ratios, profitability ratios, and as well as the how we can improve those ratios. Now let's talk about the limitation of ratio analysis. Now first of all, of course, it is only a numerical value. It only gives a numerical value, but they do not contain the underlying factors that result in that ratio. That means that they cannot themselves analyze the cause of poor ratios or suggest potential solutions to the problem. So even if someone have used ratio analysis, any stockholder have used ratio analysis and saw that okay, the managers have, for example, used ratio analysis to assess the profitability of the business, and they see that the business is not doing too much profitable, but they can't easily identify that where is it that the ratios have fallen. Why is it that they have poor ratios? Why is it that they have this? Okay, they can't directly identify the problem or see the solutions for those problems. So ratio analysis themselves won't do that. You need some other things. They might have to carry out some other techniques to help them, to aid them in making this, to identify the problems and hence provide solutions to those problems. So for example, liquidity ratios might be good and profitability ratios are weak due to the business holding high levels of inventory. Now, so of course, if you hold a high level of inventory, your current ratio would be very high. So that would mean your liquidity ratios are good, but probably you're not. Your profitability is not going too well because you're not making enough sales or something. Okay, so you don't know why is your profitability ratio weak. You know that okay, my liquidity ratio is high because I have enough inventory, but why is it my profitability ratio is weak? Or is it that my liquidity is also not good? It's just because of this inventory that I have good enough ratio. So like you don't know that. So this will give a higher result for the current ratio. The high levels of inventory will also generate associated costs such as security and insurance and the inventory held, which will mean that the sales are not made, which could reduce gross profit and profit margin. So that way you can see okay, if you look too much in deep, then perhaps you can see why is it that your profitability ratios are weak, but still they only give a numerical value. They don't tell you the underlying factors that result in that ratio. So this quantitative information such as these ratios may also require qualitative assessment. Okay, they are good quantitative information, but they also need some qualitative assessment. A company may have environmental or human rights objectives that may increase their cost but will prove to be profitable in the long run, but the quantitative data won't show this information, of course. So if you see a business that has a low profit margin, the first impression that comes into stakeholders or you as an investor will be that this business is not worth investment, but you haven't seen this qualitative assessment. You don't know that perhaps this business has a very good CSR policy because of which it is continuously gaining consumers and eventually in the long run it will be quite profitable, but you don't know that. So because of the quantitative data you might say this is not worth investing. Your ratio analysis is not too good. Okay, this is limiting. The latest data may already be out of date, so of course 1 year's result may be of limited value due to the ever-changing market dynamic. Okay, to the ever-changing business environment. Of course your business environment is continuously changing, so you might not, okay, 1 year ago your ratios were good, the next year your ratios are not good, but it could be because your competition has increased and according to your competitors you are doing very well. You have still survived in the market. Your competitors have somewhat failed its operation, but you are still in the market. But since your ratios are not too good, someone will say okay, the business is not doing too well, but they are doing well. It's just that the environment has changed. Okay, they are still doing well, so that's why it is probably out of date. Accounts may contain window dressing. So, okay, one more point I forgot over here, that it's not just about that your environment has changed. It's also because it takes time for those accounts to be published. So by the time your accounts are published to you, okay, it takes some time. So let's say 2 to 3 months before the accounts are published. So you don't know the account that you are seeing right now, that's 3 months ago, what has happened before. You don't know the current situation of the business. What is the business now? Perhaps it was in liquidity crisis before, but is it still in a liquidity crisis or not? perhaps it was having a profitable situation with 3 months ago, but now the dynamic has switched. Now there's an economy recession in economy. Is the business still profitable? Is the business still doing good because of the influx in competitors? So what is the current business situation? You need to know that. So that's why the latest data may already be out of date. Now, window dressing is one of the most important factors that limits the usefulness of ratio analysis. So I've given one example over here that one method a business may use to achieve this is to bring forward sales from future trading period into the current one. So this can increase the revenue earned without affecting costs, and therefore profitability ratios will improve. However, the revenues and the profitability ratios will be adversely affected in the next trading period. So perhaps you don't have enough, you haven't made your sales yet, but you know that okay, in the next month there are so and so sales deals have already been signed, something like that, you will make a good amount of sales, so you just include those sales, the profits made in those sales, in your current income statement as well. Now this will mean that you have a good profit margins, but that is only because you included the next future sales now. You can't include those future sales in the next trading period. So when you are making the income statement of the next period, then at that time you will be short of certain profits, and therefore your revenues and your profitability ratios in that next trading period will be effective. So that's not a good thing. It's a short-term solution. So your investors will be convinced, okay, this is a good investment, but later on they will realize, oh, this was not a good investment, and they have just not used their funds properly. They have invested wrong. Another simple way of window dressing is to carry out a sale and leaseback deal, which would improve the liquidity ratios, as business would have good amount of cash through the sale of asset and small current liabilities for the rent of leasing. So that way the business will be like, oh, you have a good liquidity ratio, someone will see that, and suppliers will be okay. But then it's just because of this liquidity ratio that they are just seeing at this liquidity ratio, because you have sold an asset, you have good enough cash in hand, but perhaps you have not been doing too well. Perhaps throughout the year you have been having liquidity ratios, and this is the one time you just sold your asset so that you can display a certain good information, but that is not the whole year situation. Perhaps you will be in a liquidity crisis again because of your previous record, and now you cannot sell your assets further because you don't have enough assets that you can sell. You need those assets to continue production. So because of which your your worth, it shows that at that time the investors will realize the true worth of the business. Okay, so that's why those ratios are limiting. That's the time. Okay, the ratios don't show the current situation or the overall situation of the market. They are just showing you, okay, what happened at this particular moment and something like that. So company comparison may also be difficult with different year endings. So not always it's a perhaps you are doing too good overall in the year, but at one particular point when you had to draft up your balance sheet, your statement of financial position, that is, your business was not, you had certain costs into the business, you had certain issues, so at that time, because of which it will display your business as being not a good one, not a good investment. But you have been doing profitable throughout the year, and just after that particular month you are again profitable, but it doesn't show that information was not shown because it was just a snapshot. The balance sheet is just a snapshot of the overall business performance, so it doesn't tell you about the whole performance. It just tells you at one point of the year. So because of which you can't compare it with your competitors. Perhaps it may display your competitors are doing bad, but they have been doing good throughout the year. It's just that at that particular moment you think your competitors are doing bad, but afterwards they are back to their normal position, they are still doing good, and then you suffer, and then you realize, oh, we are not doing good, the competitors are actually doing better. Okay. And another limitation is that competitor companies may use different accounting principles and procedures, or different ways of valuing assets, or even window dressing, hence making comparison difficult. So when you are comparing data, it's not too easy because there are lots of different accounting principles out there, lots of procedures, lots of different ways to value your assets when you are making up your balance sheet. So because of which you can't easily compare your information with another, you can't easily compare your ratios as well. So ratio results on their own are of limited value. They need to be viewed over a period, a trend. they need to be viewed over a period of time, a particular period. Okay, what was the last year, what's the last year, or compared with other businesses. So we've talked about that as well, that comparing previous information and comparing with competitors, that as well have limitations to it. Now let's look at particular what are the limitations when comparing with competitors in terms of comparison, since there has been common in exams there has come a separate question for this. So comparison can only be reasonably be made between businesses in the same industry and of the same size. So remember, we have talked about this, that when we are talking about liquidity ratios, that retailer businesses are likely to have less current ratios as opposed to manufacturing businesses. And we've talked about profitability ratio, that certain businesses will obviously have lower profit margins, hence lower profitability ratios, because they are not dealing with high valuable things, like they might have low profit margins because of they are a fast moving consumer good business, as compared to jewelry business, which would have high profit margins because it's a you know a brand thing, you know it's a luxury. So large business is likely to have more purchasing power than a small one, and is likely to receive discounts that reduce cost. This will be reflected in ratio analysis. So you can't, not just about the industry they are operating in, it's also about the size of the business. So large businesses can avail economies of scale, smaller businesses cannot. So that's also affects your ratio analysis. Ratios are calculated using past information. The present situation is different. Businesses might be quite different, okay, in present situation. So one business might be researching and introducing a new product shortly, which could alter its ratio significantly now and in the future. So because of the research and development cost, the business was incurring a lot of costs and all, which was stated in its income statement, okay, because of which its profit was less. So your ratios would also be less. But then that does not mean that the business has been a bad performance. No, perhaps now after they have released that information, after the accounts were published, after that 1 month period, they have launched that new product, and now they are making a lot of profit from that product. But that was not shown in the past information. The information was past, okay, it's outdated now. So that's similar to what we've talked about before. Ratios do not get qualitative information such as level of motivation of the employees. This can impact future performance and therefore ratios. So perhaps business A has a highly motivated workforce, because of which or perhaps now they have just introduced some new methods of motivation, like team working, or they have trained their employees just few months ago, and now they expect that the future performance will be amazing. But previously their ratios were not too good, so your competitors you will think as a competitor that the business is not worth competing. But perhaps because of this new motivation in their workforce, their productivity has increased, they are making quite number of sales as compared to your business, and that becomes quite an issue. Ratios can give useful trends and comparisons, but should be treated with caution, as many underlying factors are also considered. So you just don't go over directly with ratio analysis. You also look at the qualitative assessment like motivation, looking at the CSR policy and other stuff. So that's all for today. Thanks for watching, and Allah Hafiz.